All right, wonderful.
Hello, everyone. Thanks for joining. I'm Vishal Arora. I'm the co-chair of the New York chapter of Punjabi Chamber of Commerce. I'm very excited for today's event. It is an event which is really near and dear to my heart, how to grow your business with acquisitions. We have a wonderful chamber. We have a wonderful panel. And before we go in, I would like to bring on Gary Pasricha, who's the founder of Punjabi Chamber of Commerce. Gary, could you walk us through what is your vision for Punjabi Chamber of Commerce and talk to us a little bit more about it for the new people who are joining for the first time today?
Yeah, thank you, Vishal. I want to welcome everyone to a wonderful webinar that we're going to be having on Rollups. So a little bit of background about Punjabi Chamber. We are a nonprofit which were formed in 2017, and now we have 13 chapters, and our mission is to unite and enrich the global Indian Punjabi community. And we do that by creating a network of businesses and professionals that can help each other. So we encourage you guys to join Punjabi Chamber. It's free, it's open to non-Punjabis as well, no issues. And you can get on our directory. And we're also doing a lot of wonderful things when it comes to mentoring. We're forming an investment group, and we're doing a lot of other things. So we welcome you to today's webinar, and I'll hand it off back to Vishal. Thank you.
Thank you, Gary. We have a wonderful line of sponsors who have sponsored today's event, and I would like to actually recognize them first before we start with the event today. I would like to start by recognizing Meena Chib from MassMutual. Meena, can you please tell us about yourself and your company?
Sure. Good afternoon, everyone. This is Meena Chib, and I'm in the financial industry last 10 years. And this is the real nice working in the industry and helping community. And on the note of MassMutual is a 170 years old company, Fortune 100 company, which is ranked 7th in a row amongst the most ethical companies in the world. It's a front runner not only as the highest dividend paid company, but also in the range of products. We have been helping community, our own community and others who are, by providing free life insurance who are low income group. And this is a great support to the people, those who cannot afford to pay premiums. It is free for them. And a big thank you to the health workers who are helping in this pandemic by offering them free life insurance. And MassMutual has allocated $3 billion towards that. It's a big thank you to them. So that's what we do. And we help the community to plan their financial future. And in any terms of we can secure their future, if we can secure the family, that's what we do. And thank you very much for giving us an opportunity to speak up about ourselves and about my company. And I'm so proud to be working at MassMutual. Thank you so much once again.
Thank you, Meena. Really appreciate it. And thank you very much for sponsoring today's event. Next, we have Rajesh Grover from Aura Health Solutions. Rajesh, please tell us about yourself.
Good evening, everyone. Thank you for joining us on this webinar. Some of you already know me, but I will start by introducing myself. My name is Rajesh Grover, and I own a startup company called Aura Health Solutions based in Somerset, New Jersey. As the name itself says, we are a healthcare technology company focusing on new and advanced solutions for physicians and hospitals around the country. Currently, Aura is focusing on Medicare-based chronic care management program, where we monitor patients that have chronic diseases like diabetes, high blood pressure, COPDs, and through our remote patient monitoring platform and innovative devices. By using our platform, we reduce hospital admissions, improve patients' health, and the physicians get reimbursed for these services. Under our unique model, for every 100 patients a physician enrolls, they make additional $100,000 per year. That's only for 100 patients. And some of these physicians have 500 to 1,000 Medicare patients. In coming weeks, we will be launching our telehealth platform with unique features, which will be a game changer for this industry. For more information, visit our website, aurahs.com. I thank you all for your time, and special thanks to Punjabi Chamber for coordinating this event. Have a great evening, everybody. Thank you. Thank you, Vishal.
Thank you, Rajesh. Really appreciate the sponsorship. Now we have Rohan Handa from New York Life. Rohan, take it away.
Good afternoon, everyone. This is Rohan Handa. I'm an executive partner with the Queen's General Office of New York Life. First of all, I want to thank Gary, Vishal for putting this all together. Thank you, everyone. And proud to be a sponsor of this event and others that will come up. Brief background about what we do. I'm a recruiter with New York Life. As an executive partner, my job is to recruit, train, and develop. New York Life is a career agency. We are the largest mutual life insurance company in America, and we offer opportunities to individuals who are seeking alternative careers. As the platform, the business platform grows post COVID, there are many, many opportunities that are available in the financial advisory platform, where a growing number of people need financial advisors to guide them through this uncharted territory. So when this does happen, opportunities open up. There's a great pool available outside of talent. So if you know anybody who may be interested in joining New York Life, we'll be glad to offer. A little bit about the company. We are well positioned right now with a humanitarian grounds. What we've done is we've acquired Cigna's group life and disability operation as of December. This is a merger and acquisition, which is very, very hard to find in industries like ours. We'll be getting into a disability platform where we can offer disability insurance. And also Cigna and New York Life together formed an organization called Brave of Heart for COVID, where the seed money of $50 million, we were able to help hospital workers and volunteers who passed away taking care of COVID patients. There is benefit available, both short-term and long-term, for the families of these parish workers who can apply for these benefits. It will be my honor and pleasure to help anyone who may want to seek these benefits for any of their friends who may be affected. Thanks again for this platform. It's a pleasure and honor to be here as a sponsor. Take it over, Vishal. Pleasure to be here again.
Thank you, Rohan. Once again, thank you very much for the sponsorship. We have another sponsor, Chetan Dogra from Dogra CPA. Chetan, are you here? I don't think so. He's here. Thank you very much to Dogra CPA for the sponsorship. Now I would like to bring upon Vijar Kohli, who's the moderator for today's great event. He put together the whole event with the help of others in Punjabi Chamber. A little bit about Vijar. Vijar is a partner and co-founder of Golden Door Asset Management, a Newark-based investment firm founded in 2013. He specializes in distressed opportunities and works closely with private equity and family offices. I personally know Vijar for a while, and I learn every time we talk. He has something new to offer, new to teach others. Thank you very much, Vijar, for spearheading this. And I give it to you. Now, please take it away.
Thanks, Vishal. Thank you, Gary, and the sponsors for sponsoring the Punjabi Chamber, taking care of the event. Today, we're going to talk about roll-ups, so growing your business through acquisition. Three panelists are quite experienced in this area of financing or growing your business through this area. We're going to talk about how to choose an industry, the challenges they faced while picking the business problems, and then how they built their teams and where to go to raise capital. So quickly, we'll begin with an intro from each of our panelists. They'll talk about their backgrounds, and then we'll open up the entire panel for a Q&A. So if you have any questions throughout the webinar, please feel free to drop it in the chat. Vishal and I will be monitoring the questions and have them answered by the panelists in an orderly fashion. And if you'd like to ask them directly, we'll open it up maybe in 20, 30 minutes. So let's start off with Kamal. Kamal, if you could just go into how you came across your business 20 years ago, how you started it, and where you are today, and then we'll pass it off to Ike and then Jay.
Sure. Thank you, Vijar, and thank you, Punjabi Chamber of Commerce, Gary, and the team for putting this together. Appreciate being called on this webinar. Just a quick background, I'm the CEO of Ike Group of Companies. We are a leading provider of contingent as well as managed services in the area of healthcare as well as pharmaceutical industry. We have a pretty diverse platform where we work in 4 complementary segments, providing these offerings to our customers, primarily in the nursing area, allied, life sciences / information technology, and recently we added physician staffing or locum staffing as we call it. My background, I am an immigrant, was born in New Delhi, came here early years, did my high school in New Jersey. After high school, I went to Rutgers University, did my bachelor's in biochem, and just like any other immigrant, Asian immigrant, was pursuing medicine, but saw a lot of opportunities back in the Y2K area in terms of technology. So I changed gears, went to NJIT to do my master's, further pursued my education in Columbia for my MBA. And going into the industry, we saw a massive opportunity in the technology side. So our company initially started with IT staffing, consulting work in the Y2K area, primarily for large hospital systems, nursing homes, and the large pharmas. As we grew out of the Y2K, we continued to look for opportunities, and we saw there is much broader service offerings that we can offer to our customers in the hospital space than just IT. And that's where in 2001, we opened our first healthcare division or segment, which primarily catered to providing nurses to these large hospital systems. As we continued our journey, we saw healthcare is not just nursing, and you can continue to expand. Again, being an entrepreneur, the biggest thing is how do you diversify yourself? How do you make yourself differentiate from your competition? And that's where we continue adding service lines into our business offering. We moved from nursing into allied services, and when we say allied, it's primarily therapy and associated services to therapy, which is PT, OT, speech language pathology. And as we continue to expand, we wanted to become a full service provider in the healthcare area. So we continued to move from IT into the pharma space and also do clinical as well as scientific staffing, which are kind of niche offerings in our industry. Recently, 3 years ago, we added another physician staffing firm through acquisition and started the physician staffing called Locum Tenens. Again, the journey, we always believe a lot in the initial years in terms of organic growth. And that's what you are taught being an entrepreneur. You continue growing through that. But soon we realized that, the market conditions, the outside factors which are beyond your control, continue to pull you down as you're continuing to growing. So that's where we went on the journey late 2000s in our first acquisition, which gave us a taste of how to acquire a company, the challenges that entrepreneurs face in terms of financing some of these acquisitions, as well as the culture that you build and integration of these platforms. And in the last decade, we have done 10 acquisitions. And I'm proud to say that all of these acquisitions have been pretty successful and have continued to help us get to the levels where we want to reach. Currently, Ike Group stands in the top 20 healthcare / clinical scientific staffing organization in US, and we continue to expand on our role. We'll talk a little bit more in detail as the webinar progress, how we were able to get the financing, how we brought a PE group to help facilitate some of the larger acquisition, and the journey hasn't stopped as of yet. We continue. This was a big milestone for us, and we are now looking at doubling, tripling our company in the next few years to come.
Excellent. Yes, definitely. I think a lot of people want to know about the private equity raise. Ike, if you could go into your background, how you also are a New Jersey native, and where your history of Rollups are in the technology space, please.
Sure. Thanks, Vijar, and thanks, Kamal. That was very very interesting, your background. So, hello to everybody in the Punjabi community. I'm a Delhi born and raised Sardarji who went to Springdale's in Delhi University, Sri Ram College of Commerce. And during my final year, migrated to the US. And like many Punjabis, ended up at my Masi's place. Masi, just like my mom, gave me all the encouragement and love, along with her family, her son, who I grew up looking up to as an older brother and a role model. So I had great fun. I was lucky to have a great support system in the US. It led to additional education while working, and I ended up taking courses in finance and marketing at Rutgers, and very quickly got absorbed in the tech space. And by virtue of just tech being what tech is, it took me right into, I got thrown right into fire in projects that the companies were delivering into Wall Street and all sorts of different industries in the country. After a couple of years of putting time, energy, money, and grit into following role models and opportunities, it led to deploying a number of trading floors, software, hardware for some of the biggest banks in the world. And then tech leads you to Silicon Valley. I ended up in Silicon Valley, which led to a management buyout of a company by a few folks. I was one of them, the youngest one, and a group of very good partners I had found and mentors. And it led to a decade full of acquisitions, maybe close to about 40, 50 acquisitions, half a dozen and more roll-ups, raising hundreds of millions of dollars in these acquisitions, primarily companies that were in the networking space and dealing with data accuracy, data transmission, data security, and optimizing different industries. That's what technology does when you get into it. And that led to a number of verticals within the networking technology space, optimizing different industries, either media or other forms of tech or security or surveillance or financial markets or film, animation, and healthcare. So different verticals and these opportunities, going through management buyout can probably tell you that you're dealing with an acquisition where you don't have the money and you have to find the money right off the bat to pay for yourself. And so it leads to a different breed of skill sets that you are learning as you go, and with mentors and friends that you have around you and partners. And it was a great decade of, identifying an opportunity, a unique opportunity, structuring the transaction, and then due diligencing this transaction and financing the transaction, and then integrating the cultures, the human capital, making sure you're retaining what you really acquired. Did you acquire to build? Did you acquire to just rescue? Did you acquire to facilitate growth, not just short term, but maybe hopefully a sustainable business model that's for the future, building value? Because a number of folks can get indulged in these acquisitions where you can be just in for the fee, a short-term gain, or a financing and a transaction that allows you to live and live a little longer rather than a sustainable business. So having gone through a number of these transactions, acquired a sense of what you're really getting in for, what industry you're looking to do a roll-up in, what is the purpose of the roll-up, what is the short-term threading the needle kind of an exercise you got to go through, what you got to be prepared with, having a team that's got a SWAT team, I call it, which is you've got to have that team that's going to help above and beyond the daily activities of your business to be able to have relentless energy, be able to multiple task, and basically be unified in that objective of acquiring a business that's going to have a successful, sustainable yield to it. I ended up being part of the leadership team and CEO of companies that had revenue streams of a couple $100 million and more, market valuations of a few $100 million to $500 million and more, and served as CEO for a bunch of them. Many of the roll-ups in the industry usually are failures. They don't necessarily survive long. The only roll-ups that make sense, and I've had a few failures, and the ones that had success had elements of everything I pointed out. They were successful because there was a long-term plan from leadership in order to ensure, and they were vested to ensure that it's not just a short-term game or a vanity play. You're dealing with people's lives, you're dealing with investors' lives, you're dealing with, depending on if it's a public transaction or a private transaction. Over the course of the last decade and more, most of the transactions I've been involved in have been non-public transactions. Public transactions there was a decade where they were really useful and had legs to stand on. Public markets today have a lot of baggage attached to them as far as scrutiny and the ability to manipulate transactions from Wall Street to everything else. So having gone through a ton of those experiences, I've been lucky to venture into different industries, from animation to media to human capital. And in human capital in particular, found another tactical approach towards roll-ups. It doesn't necessarily have to be just a corporation. It could be roll-up of talent itself. So I was co-founder for a human capital company called Options Group on Wall Street. It's in the top 3-4 firms in the world, where it basically has been globally retained by firms like Goldman Sachs and Credit Suisse and Barclays, a whole lot of different firms, and spawned of different companies that came out of them as alternative investment funds, hedge funds, names that you may know of in the market like Fortress, Citadel, Cerberus, and others. And these relationships are long-standing relationships with these folks, where we saw guys that manage money, the top 0.01% of the world, are managing money in different ways. Money doesn't sleep. They have to deploy that money to make a better yield. And what do they have to do about it? Not every time they want to trade on some opportunity or invest in some opportunity, they're going to go buy someone. And that's where the roll-up of talent comes in. And talent is priceless. The war for talent is insane. You can, for example, Goldman Sachs might be looking at a prop trading desk that's got an allocation of $5 billion that's giving them 60% return. And are they going to go build that from scratch, or are they going to buy someone? And the same thing is being viewed by other competitors and peers like Morgan Stanley or others. And it's easier for them to attract talent, build talent, and acquire talent, and a roll-up of talent in a fashion that they can not necessarily just keep buying assets that might not stay with them. So retention of human capital, retention of IP, above and beyond human capital of IP itself in tech or other industries that people are looking at, plays a huge role. I think that covers to the point where I can contribute towards wherever the questions might come from the community. As immigrants, we can see there's a lot of desire for all the intelligence that's in the Punjabi community to basically leverage the community and skill sets and come ahead. This is a great forum that you guys have put together, and honored to be part of it. And thank you for thinking of us, or me.
Thanks, Ike. Next up, we'll have Jay. Jay, if you could go into your background of going from Rutgers to the West Coast, selling your startup, and getting into the venture capital industry, it'll be great.
Jay, unmute yourself, please.
You're on mute.
Great. I was going to say, since Ike and Kamal both began by talking about where they were born, I will do the same, and I will one-up them because I was born in Punjab, India, not New Delhi. So, I just wanted to say that. Immigrated to the U.S. when I was 4 years old, New Jersey native, Rutgers, then Wharton MBA, West Coast for 10 years, where I worked for several years at Microsoft in my dream job in tech. And then in 2006, I left and started my own startup, raised about $12 million in venture capital in Silicon Valley, and sold that company in 2009. The company that acquired us, during my earn-out period, since we were the biggest acquisition they had done at that time, I became a central, person in leading acquisitions going forward for that company. And in less than a year's time, we did over between, 70 and $80 million worth of acquisitions of digital companies with a very efficient tax structure that we could go into detail over there. So from a purely conversational to the topic of today, there's 3 points of view I could bring. One is like how we acquired companies as a holding company from a tax efficiency standpoint. After my earnout was done and I came back to the East Coast, I started doing angel investing. And then I got together with the former CEO of Virgin Mobile and the former CEO of Lego USA. And we started a perpetual, holding fund, as you could call it. and we got some pretty significant LPs in there who were big family offices. And we basically started buying a large majority interest in early stage companies, 20, 30, 40%. And, we've held a lot of those companies for a long time. We sold a couple of them recently, one to Nestle, one to Rocket Internet, and, potentially, a couple more that we'll sell to big, well-known Fortune 50 brands. So we've done, so I could talk a little bit about like how do you develop a portfolio and the thesis around how we did our holdings and why we did them. But the third point also is I get to work with a lot of family offices in my career. And I'm talking about family offices, some of the richest families in Asia, France, Middle East and stuff like that. And, one of the things I got into detail with them is how they set up their internal family offices, how they set up their holding entities from a standpoint of like holding assets and what their goals were from either asset appreciation or cash. And, there's a lot of things we can go into, whether it be the technical structure of how they did that and what's the right way to do the technical setup of your entity, and then also the thesis of how you want to, build and grow your entity through acquisition. And we can go into detail over there, but those are the most relevant. I was also co-chair of Governor Murphy's transition team on the technology and innovation side. And I've also done several talks along with Congressman Frank Pallone on tech and, the challenges that tech faces and whatnot, especially in this world of big social with Facebook and everything.
Excellent, excellent. So why don't we start off backwards from the world of finance? One of the questions that came up was acquisitions versus roll-up. Someone's asking what the difference is. Jay, why don't you jump into, e-commerce is obviously the biggest area of growth in 2020, given the pandemic. Can you describe what's happening in the market? And then maybe what the difference between an acquisition and roll-up is from your side of working as an investor versus an operator?
Yeah, so e-commerce, we were very worried about when, the pandemic hit that a lot of our brands would get affected. The one thing that helped us, our thesis was always to invest in brands that we felt like were the future. So what's the next generation of healthy food delivery? What's the next generation of healthy vitamins? What's the next generation of healthy home workout equipment and home workout clothing? And our companies have done exceptionally well. They've grown much more than we've even projected before this entire thing happened. And the reason is because there's just more people online buying stuff. And, online has, the thing I tell everyone is that the digital world has grown by 10 years because people who are elders who'd never used online are not buying their groceries online. So everything's accelerated. The market size of the online consumer has grown a lot. So there's a lot of interest in a lot of D2C companies. And, a lot of the CEOs I talk to in direct consumer brands, they're getting approached for acquisition very quickly from legacy brands. So, a company like P&G, a company like,
Nestle.
Nestle, for example, or, another big brand that's like, or even Home Depot, a lot of them are approaching innovative companies saying that, this is the future and I'm willing to pay a premium now versus waiting 2 years and having to pay even a more premium because you might be even bigger by then and I can't internally innovate. So the way I look at it, if you're an online direct to consumer, this is, we've accelerated the growth by 10 years over here. And, acquisition, it's kind of interesting, like acquisition is more like, hey, I'm going to buy this. And like the way I look at it is like growing through acquisition is us buying the entire entity throughout. I look at roll-ups as more like, buying smaller entities or pieces of entities and owning a majority controlling interest in them, but not buying the entire thing, right? And so if I look at that, like a lot of family offices I work with, they like to own the entire thing. Like they want to own the entire company. A lot of holding companies that are set up by other people, especially multifamily offices, they might do something where it's like, hey, I don't need to own everything as an acquisition. I might do a roll-up where I own 30, 40% of each one, but I have a board seat and I have controlling interest in some way.
Right. Excellent. So we'll come back to that, the difference between a holdco and an investment company when we talk about taxes. Kamal, let's come back to you and talk about starting from scratch, building a business, which was a small business, which is now sizable, and then finding a private equity firm to help you financing. So that growth, that organic to inorganic growth that takes place in a roll-up.
Absolutely. So we have been, starting as an entrepreneur from basically zero to where we are. We kind of played both sides of the equation. We started our growth trajectory and our strategy was primarily doing acquisitions so that we can really come to a size where PE firms will evaluate us as a platform. Once we engage with the PE, now our strategy is more of what you can call as a roll-up strategy, where the goal is primarily just keep acquiring at a lower multiple, and the end objective is to sell at a higher multiple based on the sheer EBITDA growth which we are seeing. So going back on, acquisition, the primary targets which we were defining, we had a multi-pronged approach in terms of acquisitions when we were looking at. We picked an industry, especially the healthcare staff augmentation or contingent staffing industry, which is highly fragmented because of the licensing which is required, state-to-state bureaucracy, as well as policies that dictate that industry. And as a result, what we saw, if we wanted to really grow nationwide player, we really need to go out into different geographies. And that was one of our prong approaches in terms of looking at acquisition targets that will give us a play in different markets where we are not providing services currently. So we looked at markets which were really expanding, the Floridas of the world and all of the markets where healthcare was really booming. And we started targeting companies in those geographies to help us accelerate our growth. Another thing which we looked in our strategy for acquisition was, let's look at companies, even if there are competitors in the existing markets where we have a play, how do we bring them on so that we become sizable? Or if their competitors are offering services which we don't currently offer to our clients, so we can bring those service offerings back to our existing clients and create synergies on the front end. And during acquisitions, early days of acquisitions, I read multiple books, multiple stories on why acquisitions fail. And the biggest key takeaway for us was most acquisitions fail because of over-integration. And that's what we try to stay away with. People, whoever have built their companies, once you acquire, our goal was not to over-integrate. Let the front office run as is, let their sales team, whatever culture they have built at the moment, let it run in that environment rather than bringing on your culture and trying to make changes too fast where people get threatened, your employees get threatened, and as a result, you lose players who are your ultimate performers. So we try to not over-integrate, let the companies alone, and we try to look at where are the back-end synergies that we can take advantage of, whether it's accounting, whether it's IT, whether it's HR, because those are back-office shared services that do not impact the front-end sales team or your business offerings as much. And that's where we started creating back-office synergies to bring cost savings and sheer play of volume to the vendors which we were engaging in. And that has really helped all our acquisitions till today, very successful. We retained the management teams as much as we could by management incentive shares in certain cases, and as the company continued to grow, we were able to bring them into different roles based on their experiences, where they could add into the continuous growth of the team where we stand. One thing which I mentioned, acquisitions become successful based on the teams that you assemble. But again, when you are an entrepreneur starting from scratch, you don't have the capability to put those teams together. Today, I can say we have a full deal team, which is engaging, which is going out, looking at identifying targets for us. We have, once it moves from that point, we have people like KPMGs who will do our due diligence, and then we have a full, the legal team which helps us close this deal. But in the initial days, the CEO or the owner or the entrepreneur is the one which acts as a due diligence guy, who acts as the deal closing guy, who is fishing for new opportunities. So you have to be mindful without impacting your current business line. How do you run and how do you make time in order to make sure you continue on this path? And as you continue to grow, you will start engaging certain people in your groups who have the bandwidth so that they can help you take on some of these roles as you grow. And 3 years ago, actually, once we were at the size where we felt we could be a platform to some of the private equity firms, because it's a share EBITDA play where they don't want to look at companies below 10 million of EBITDAs. Once we crossed that threshold, we felt we really needed to do acquisitions which were much bigger. And we went out in the market. We spoke to almost 13 different PE firms, and we had a very clear strategy in terms of which PE do we want to engage. We wanted somebody who has experience in the healthcare area. We wanted somebody who are not operators and would let us run the organization with at least a sizable control so that we can continue taking our vision forward. And we found a partner, which out of Canada, which was very helpful to us, and they exactly fit into what we were looking at, the right PE firm. And just working with them, they pretty much, our one major objective was to have access to additional financing to make the bigger deals, and that's what they were able to provide to us. In the last 2.5 years of our engagement with them, we have done 3 deals, which are pretty much 3 times the size of deals we have done in the last 7 years. So it changes your trajectory in terms of how you're working, how your mindset is. And now I would say these deals which we are doing, and the PE brings a lot of experience to us, where they are helping us maneuver the play of roll-ups rather than us just trying to do acquisition to grow, and how to create synergies in terms of cost savings, how to really evaluate EBITDA of the organization, how will it continue to add. So that has been a tremendous help for us, engaging a PE partner in the last couple of years.
Got it. So could you talk about how you source deals pre the private equity partnership and post? You know, how do you go about finding, you're essentially acquiring competitors, whether vertical or horizontal, so that conversation can be difficult. It can be challenging to find smaller businesses that are below that $10 million in EBITDA. How did you go about finding those deals? And then how did you finance them before raising capital internally?
Sure. So pre-PE firm, our acquisitions, we used to go to a lot of industry events, especially there are events where your competition is there, and we started talking to, and most of these events have sponsors or bankers who do small deals, and we started talking to all these bankers, telling them we are in the market looking at opportunities. And pretty much once we did our first deal, which was pretty small, from where we look at today, it was just $1 million EBITDA we acquired. But now when we look at it, we took that deal and we marketed the hell out of it in all of social media. We engaged multiple newspapers and did a full-fledged marketing of inquiries out in the market, looking at acquisitions. And that brought a lot of investor bankers into play with us, where we started getting at least deal sheets from multiple groups that we were evaluating. But we were very strict in terms of, and we are still very strict with the terms of acquisitions we do. If it doesn't fit in the box which we have created as our strategy, we try to shy away from it, because there's no point of trying to fit something in just because the numbers look too good. And that's another reason why some of the acquisitions fail, because you can't just take it as a pure number game. You have to look at how the culture will evolve eventually, how will it fit into your overall organization, and are the people running that groups, are they having the similar mindset what your organization has done over the years. And coming back to financing these, you know, again, starting small, you don't have a lot of financing options. You know, there are 2 easy options: is either you put your own money, or you are able to get line of credits to any institutions that are out there, the banks that you deal with. The other type of financing which we leveraged after we ran out of a line of credits were asset-based lending, which is kind of a hybrid between line of credits and factoring, but at a sizable rate where you can still have enough play with your margins and continue making deals, and it makes sense to run your business. Because a lot of companies I've seen have failed where they go the factoring route in order to grow fast, but if the margins within your industry cannot sustain those kind of interest rates, you are going to suffer badly, especially when the market conditions change as we are today in this kind of a pandemic.
Excellent, excellent. Thank you. Ike, there's a question that came up. If you could talk about, one, categorizing acquisition targets, and then two, the role of an investment banker, since that's something you've done as well post Rollups.
Sure. So I'll start backwards. I can start either way.
Mm-hmm.
Acquisitions and identifying them. I mean, it depends on the industry you're in and what life cycle you're going through in your own business. So as Kamal, pointed out, he was the start. He started the business himself as an entrepreneur. Had to start from scratch. Didn't have the team, and slowly got to a point that he put together a team. He had to do everything himself. It goes back to what I was pointing out earlier. You got to be able to have yourself be the multiple tasker, and then others you add to yourself are similar or better than you. That's how you build a team. So identifying a business will depend upon which industry you're in, what life cycle you're going through. I hinted towards some of the comments I made earlier about, are you going in for a roll-up or an acquisition? An acquisition could be to build upon your current business, organic products, the complementary products. A roll-up could be beyond just an acquisition. It could be multiple acquisitions, and it could be beyond your focus and complementary products and complementary revenue streams. And so I think I saw one of the chat questions coming out saying acquisition versus roll-ups. I wanted to attack that while I'm addressing this as well, in the sense that acquisitions you can build with, that's great. Roll-ups end up being in a position where the whole idea is to create enterprise value, not just acquire a product or a business unit by itself. The bigger picture is creating enterprise value. How do you go identifying those? It also leads to how do you go source them? Identifying eventually leads to how do you source them? So once you know the industry, what life cycle you're going through, are you running a company already where your profits are gone, your margins are depleted, and your valuations are going down and down if you're already public? If you're not, you're private, you're dealing with the same challenges without the stock value going down all day. And so are you going to go rescue that enterprise value in the same core business? Are you going to go acquire inorganic growth via acquisitions that will put you in a zone where you can use financial instruments like leverage finance to bring back enterprise value? Are you in a phase of a life cycle of the business where the products that you've been building, running, and selling are basically getting old, and you need to transform the business into leapfrogging into what's the next wave of these products? Where in the life cycle of that operations are you running the business will define what you really need to bring in. And then where do you source these from? It could end up being, a number of sources where we've been able to leverage upon our peers in the market, having a friendly conversation of who's where in their lives. They're not just competition. They're as good competitors and friendly game in the business. You can, those are some of the best ways to see that might be a good opportunity to pick up something that you're already familiar with, a relationship you already have.
How would you differentiate yourself in those conversations? Because there's a lot of that going on today. What would you say to, make yourself look different?
Sure. So there's many different ways you can be unique and differentiate yourself. A lot of that is happening today, like you said, rightfully. It comes down to the fundamentals of the business. It could be a business that's caught in a life cycle of some sort of harm or some sort of event, such as COVID, where clients have disappeared, products, great. It's paused for revenues for now, or it's burning money because of debt coverage versus the ability to sustain themselves. So being familiar with those situations allow you to, perhaps if your fundamentals are better, put you in a zone where you can take advantage of these unique scenarios or market environments. And if you've had the experience, and if not, it's never too late to start first time around, to actually take the initiative and put together that transaction by not just identifying where the unique opportunity in the life cycle is or the product is, and putting together a plan of financing it. That brings me to the second point of another way to source these transactions is with existing financiers and banking relationships that might not be getting their debt coverage, or investors that are not happy with the return on their investment and the business has lagged. That could be a target. Unless you're in the flip side of this is if you're already ahead of the game, like Kamal seems to be, and he shared, kudos to you, Kamal. where you're sitting with a war chest and you're saying, I'm not waiting for some acquisition just because they're very profitable or just because they're weak. I'm looking for a very strategic, acute view of like, this product is what fits into what I'm building. And so I'm not going to waste my time on filtering the noise as to what really adds value or not. So he's got a very, that's a great acumen to have and a strategy to have. The other is having accountants. Those are a great source of acquiring businesses because they're servicing people like yourself in the space. And lastly, it's obviously advisors and investment bankers. The investment bankers and advisors or board members can be really good mentors and partners where with their reach, relationship network, and experience, they can be a sounding board to be able to bring transactions, to be able to vet transactions, to be able to guide the path of been there, done that, and hopefully wisdom if they've got some hair left. And so, or maybe white hair, right? So all of that hopefully makes sense on what you asked, and I'm answering towards.
Absolutely. Jay, let's talk about content and commerce. You know, someone's asked about the next 12 months of the industry or the entire market. You know, investing in e-commerce or retail commerce is a big change. So you're either buying the IP, the brand, the inventory. How do you look at the market over the next 12 months? And how is it differentiate? And then let's talk about afterwards about content and the tax strategy you implemented in the past.
Yeah, I think, I mean, the next 12 months, if someone's looking at, you know, like I tell everyone, like I'm all bullish on direct to consumer. You know, my portfolio personally and professionally is 80% direct to consumer brands. And I think the way you want to look at it is that, you know, everything can be replicated. At the end of the day, like, you know, if you come out with the next great handbag, that could be replicated in 24 hours by any other hungry person, right? So what really comes down to is that can you build a online brand that's interesting, that's valuable, that's you know, compelling to the consumer, where the consumer trusts it and says, this is what I want to use and trust right here. And you know, we've had a lot of situations where some of our companies, when they started getting big, we had all these little players come out and basically copied everything. In one case, they actually copied the image of the founder's kid in their it was just the weirdest thing. We're like, come on, have at least some, you know, some creativity on your own. And, you know, but they weren't able to compete the quality of the brand and the quality of the experience. So I think if you're going to build a brand or buy a brand, you know, or a company, I think you really want to look at, do they have a great product and do they have a brand that people trust and want to consume? And because at the same time, that's what a big company is going to buy down the road.
Exactly. Are there industries that you would look at that you can't do yourself right now or you're looking into? Some people are asking about
industries. I mean, health is big. I mean, health is going to be even bigger. I think online fitness has gone through the roof in terms of like home fitness and stuff like that. So anything health, fitness, food related about health and stuff like that, those are all going to be really big industries. We're seeing a lot of momentum and velocity in those types of investments. Where I'm seeing now, on the flip side, where I'm seeing people saying, forget this, is like luggage companies, right? There were some luggage companies that did really well last year, and now they lost 95% of their revenue, or travel networks that were, you know, starting to get a little bit of a momentum, and they've gone down, right? So now everyone's looking at the new world and saying, hey, you know, if we can make people healthier, happier, and make them fed better, easier through digital delivery, that's going to be a big future wave. Great.
What about when you were at your startup and you sold out? Can you talk about the tax advantages of buying, let's say, internet businesses, or at least how you could finance them and make them cash flow profitable?
Yeah. One of the most interesting things, and like, you know, you really don't learn these things until you actually do them in person and you see the real value. So one of the things we used to do is, you know, we'd find a business and say, okay, we like that business and we want to buy it. And we approach the founders, and it'd be a digital company, D2C company of some type that's generating free cash flow. And what we say to them is like, look, we want to structure this acquisition not as a stock purchase, but as an asset purchase. So we're buying the assets of the business over here. The reason we do that is that we then take that asset. So let's say hypothetically we bought a business for $15 million and we paid them cash for it, but we say we're buying the assets. We would then go around and from an accounting standpoint, do an accelerated depreciation on that asset. So for the next 3 years, we're depreciating $5 million a year. Now, if that asset is generating $6 million or $5 million of annual free cash flow, which some of them were based on the model of how we bought these companies, you're basically getting free cash flow tax-free for 3 years because of this accelerated depreciation, and anything after that is pure gravy. So we had this model where we were doing almost $100 million worth of acquisitions into these companies where we had this great accelerated depreciation going forward that allowed us to basically have free cash flow tax-free. And it really allowed us to have a very effective IRR in our acquisitions as well too. So you have to do structuring. This is one of the examples where if you do the right structuring, you are disciplined in how you go about buying these companies, and you're disciplined in how you like execute, you can make a really good business out of this.
Yeah, exactly. Ike, let's get back to you and talk about the deal team, building an M&A team, from internally versus externally, the due diligence process, and then we'll talk about how to speed that up and some of the challenges involved. Why do Rollups fail?
Well, sure. So in my experience, we've seen a ton of great successes in Rollups. And then there's the part where a lot of folks want to do Rollups for perhaps the wrong reasons, or perhaps not having all the resources. And that ends up in a situation where you don't necessarily find yourself prepared. Why do Rollups fail? Probably because there's a great vision, but there's not necessarily a great execution team. And what does it take to put together a good execution team is making sure you have great retention of human capital, that either it could be internal or it could be that you hire from the outside. If you're an owner operator, internal teams, if you're a builder of businesses, that I've seen has been the most successful, because people are vested into the transaction, not for just short-term gain, but for building a business that's going to have sustainable results, great yield, and perhaps more growth out of it. Whereas when you've got, and it's not necessarily fair to say, but we can compare it in the sense that if you're hiring a outside firm to help you with acquisitions, it may work for large corporations where they're positioned in such a manner, or the business is such that they're not running it as a builder, owner, operator, but they're running it as executives, and they have a lot more resources to throw at in those transactions and hire outside parties in order to strategically and tactically get a transaction done in the time frame they wanted to. Because most of the large firms most likely are public, and there's a game where merger arbitrage starts reflecting the valuations of both companies. So you don't have the wherewithal that private acquisitions and roll-ups don't necessarily have to deal with that exposure. So you don't have that luxury of being private and not have to deal with that. So it depends on where you are in business again, what kind of business you're running, what kind of leadership that you have that's doing this. And when it comes to having a merger acquisition team, there's a lot of corporations that have their own built-in M&A teams. And when you see today in the market where a ton of PE firms, alternative investment firms that have different charters to invest in different verticals, they like to have what you call partner in residence, kind of a setup where they've got the money guys, but they're mostly folks that understand money, and then they're teaming it up with folks that have product knowledge, industry knowledge, executives who have been there, done that before, might not be running money, but they are the perfect blend together to take on these challenges and execute in that fashion. Having product knowledge, having business analysts, having accountant, and having legal support, those are the basic elements of what you need just to make sure that the roll-up that you're working on is successful. I think I wanted to revisit one of the things that you had asked Jay, and in regards to where opportunities lie. A few years ago, we set up our own family office, and we started pursuing transactions where we're investing in real estate and media and tech optimizing different setups. We found, and also I sit on a board of the wellness and organic food industry that's done extremely well. This fund's grown tremendously. But as our backgrounds, myself and my partner, Adam Chaudhry, who introduced you and me, he comes from banking, from Goldman and so on. Finance and technology, the nexus of that has got a ton of opportunities today. And we've found a ton of, not necessarily just opportunities, but growth while executing on those plans. So our family offices have invested into time and money into a lot of these fintechs. one in particular, the space that has been very rewarding in this time during COVID, work from home environment, is cybersecurity, risk, and fraud. And that business for us has done extremely well. There's a ton of challenges. There's a ton of innovation. There's a ton of new competition, but it's very, very exciting. And if you can stay ahead of the game, there's a ton of growth lined up for people in that sector.
Excellent, excellent. So Kamal, can you mention how your team has evolved from focusing on building organic revenue to build your business, and then transformed into a deal team, or now is like sourcing? There's really two different ways of managing your operations. How's that changed?
Absolutely. So as we started looking at acquiring more and more, we started talking to our senior management team in terms of freeing up their bandwidth, in terms of where their main focal point is, where their strengths are, and which part of the acquisition area can they really support. So each one of our senior management, as Ike was pointing out, you need all these multiple elements to put a deal team together, from acquiring deals, and once you have acquired a deal, who's going to be part of the initial due diligence process, who is going to really, even when you look at the due diligence process, there is multiple areas you need to evaluate. You need to evaluate their front-end operations, you need to evaluate their accounting, HR, as well as their back office, in order to ensure that are things running as the papers are showing. You can always, initial phases, we hired a few accounting firms at least to help us due diligence of the numbers, so that since they're professionals in that, it's easy for them to get in and it's more cost effective. But we were highly involved from the operations side to ensure the company, when you start looking under the hood, is really what people or the sellers are trying to sell you. And that's, once you have the confidence in the business model in terms of their operations, the numbers will shake out the way the accounting team can really look at and make sense of it. And that's where, we continue to evolve and continue to strengthen our team behind it. And as we are making bigger deals, obviously there have been bigger accounting firms which are doing the initial due diligence for us. But still, our core team, which we have established from HR side, from IT side, from operations side, and since we have multiple business units which we run, depending on where the acquisition is going to roll under, we are able to take those heads of those business units and get them involved in terms of at least talking to their front-end sales team, to their operations team, to ensure they're going to be able to fit into the culture which we have built and the box which we have built.
Excellent, excellent. Very, very good. So we have a few minutes left. If you have any more questions to the audience, please go ahead, submit it in the Q&A. I'm going to hand it off to Vishal with another question for the panelists. But submit any questions you have. If we don't get to answer them, we'll follow up post the event. Vishal?
Thank you, Vijar. So one of the questions which came up in the chat, and I want to expand that a little bit, it was in the range of EBITDA of $750K to $1.5 million. Much smaller game that you guys are playing right now. But let's go back in time. When you started this, did you do the acquisitions in that range? And what were some of the ways to raise funds for that in that space? Especially talk about like SBA financing is getting slower and things like that. So I'm asking like 4 or 5 questions in one sense, but if you can talk about your experience going back.
I think I could begin real quickly with first off, if it's a good business, we do that deal now too, right? So if you're buying a good business with good growth and EBITDA's in that range, why would you not want to have that in your portfolio? But there's a couple of ways that we've done deals in the past. One is obviously the simplest way is you just buy an all cash deal and you figure out what the valuation is. The other way that we've done that's a lot more creative, and this is a structure that's a lot more popular nowadays, is creating a series LLC, for example. So you might have a holding entity that's a series LLC, and you want to do a particular purchase, and you might need $2 million to the purchase, and you could only put in 300 of it, and you basically ask investors to come in for 1.7 million of it, make it a very easy closing document structure. And that's been something that a lot of people are doing nowadays, especially in real estate. So a lot of people who are creating real estate, holdings are doing them by series LLCs. And, they just do that for ease of, legal implementation and ease of getting a deal done. So I think those are, two interesting ways that they've been able to attract capital. Now, obviously, debt is always an option. One of the things I'm finding interesting is that outside of the traditional banks and stuff like that, there are family offices that are interested in debt. Like there are people that want debt that is not correlated to the market, right? So, for example, if I was buying this is actually a real example. If I'm buying into an entity that serves legal law firms that are doing class action lawsuits, that's very uncorrelated to the market, right? And I want to buy a company that does something in that space. A lot of family offices would be interested in that because they feel like it's uncorrelated. They don't mind giving the debt to that because they have an asset that they are protected with over here. So debt from different sources can be very interesting.
If you don't mind, I'll jump in for something I think we can add. You might agree with. I agree with him in regards to the size of the company. It doesn't really matter. It's a good acquisition. It could be at any price and at any price point. Small or big doesn't matter. The one thing to consider is, I think Jay mentioned earlier, when he sold one of his businesses, he was asked to stick around for the earnout. So that's another option not to forget. When you're especially starting out, you don't want to pay out all cash that you don't have, or you're going to borrow and make someone else rich while you're trying to slave pay that debt. But perhaps maybe a combination of raising money, as he said, and perhaps an earnout or a leverage buyout, pay as you go. When, if you can structure it, something to consider and keep in mind, especially when Vishal pointed out, when you were starting, it reminded me of that time where you don't have the money, but you want to buy something, right?
Yeah. Thank you. Kamal?
Just to add on to what Jay and I said, again, it's all about creating and creative way of acquisitions. So there are multiple ways you can structure a deal. Some other things which we have done, especially in the human capital side where we deal with staffing, there's a huge AR component which is always outstanding from the companies we acquire. So if you don't have the capital up front, we are able to structure it that we let the seller at least keep their AR, and that helps you reduce the cost, and you can always go back to your bank and just go based on asset-based lending and get some kind of a line of credit or asset-based lending on that additional ARs, which you build over the next 90, 120 days. So again, it's all about creative structuring of the deals. All of these we have done it, and whether it's earnout scenario, whether it's letting go of the AR or some kind of a financing where you pay over the period of time, and sellers of that size organizations are pretty flexible, I would say.
Okay.
Kamal, can you talk about some surprises in due diligence and how you maintain discipline when you're buying a business, not overpaying for an asset or stock?
Yeah, there are multiple things which can come through in the diligence. We have the simplest thing which a lot of people don't disclose in the initial diligence is lawsuits that they are privy to, or things which are hanging on their feet. We did a deal of a company in California, and which had a lawsuit pending from them, but it became a class action lawsuit for another similar size company and that became a deal breaker for us. So we had to structure the deal in such a manner where, unless the lawsuit was resolved, we were holding substantial amount of funds in escrow, and we made sure that the sellers were able to at least waive that off and only get access to the funds once it's done, because some of those things can really break the whole organization. And that's things. And on the accounting side, we have seen multiple things where, especially when you, in the initial phases, when we were dealing with small companies, most of the time they don't have large accounting firms managing their funds, and the accounting is primarily done by the business owner. So you would not have a clear picture of what exactly their gross profits are, what their EBITDAs are, and it's more driven by, everything runs through the company. So it becomes a big due diligence issues when you deal with those kind of organizations. And I'm sure we have all come across these kind of companies.
Excellent. Excellent. So if there are any other questions, let's see. I don't see anything else right now. Vishal, if you have anything else.
Nope, there are no other questions. So we would like to wrap it up by thanking the panelists. Vijay, anything else to add before I do the typical close out?
Adam just asked one question about the investment horizon. How has it changed? Maybe Ike, you could take this. Do investors have a longer term view? How are valuations changing across the board?
Wow. Of course, leave it to Adam to put me up to working, right? Challenge. Well, it depends which industry you're in. So what we're finding in our fintech space, the horizon is, much sooner than later. The investors are no longer just typical Silicon Valley investors. It has become a blend of investment arms of large organizations that are actually your client, your partner, and your reseller, and your investor. There are good examples of that in the market today. When you look at fintech companies in payment space, they might be coming out of Silicon Valley in the sector we're in. They've got a client like Bank of America. The Bank of America is using them in all different sectors. And then Bank of America is interested in partnering with them to provide better service in the market because there is that void. And the large companies are not moving fast enough to come up with innovation to deliver upon their legacy system issues or disjointed opportunities that can be facilitated right away. And they see value in partnering up with young startups, the unicorns that we see every week being popping out, where it allows them to leapfrog rather than deal with stale and tired and fatigued internal processes and disjointed systems. And so with that said, it answers the question in a way that you've got this new breed of investor that's your client, your endorser, your partner, your investor, and at the same time looking to take you public and take you and do an M&A for you. So that's a huge differentiator that recently has evolved in the market as an investor of that kind. The horizon for them is of all different time zones. It's immediate, it's short term, and it's long term. And then there's the typical investors that are basically, depending on what kind of charter they had on the funds that they raised, they're looking at investments of, like Kamal pointed out earlier, they're looking at companies depending on what sector you're in again, $10 million minimum checks, $15 million minimum checks. Some like minority ownership, some like majority control ownership. Some want to change the way you're operating. Some want to just let you run the way you're running and bet on the idea you've got and facilitate. And we've been in that business many times ourselves from investment standpoint, and then figuring out owner-operator positioning. And those guys, those investment funds might have 5-year life cycle, might have 7-year life cycle. And if they don't see result out of it, they like to exit out of it to get that money back and pass it to someone else. That could be a strategic buyer again. People like us again, owner-operators and entrepreneurs. So that's basically in the payment side. And then there's other industries where, if you take media, we're also invested in film and Hollywood. And if you look at that space today, it's hurting. It's not necessarily, it doesn't have any legs. No one's shooting any movies. No one's making any new content. You're dealing with Netflix basically repeating the broadcast from the past or recent acquisitions that they're making. But what happens in that industry? The investment horizon has suddenly gone on to a zone of its own that's going to be revisited when everybody comes out of the pandemic. What's happening to the valuations for companies and businesses of that sort? They've dropped quite a bit. They're hemorrhaging. Retail real estate, same thing. E-commerce has taken off, but what about their counterpart? People are paying rent for not being able to open a shop. So it depends on what industry you're in. And the investment horizon depends on some of these market dynamics that we're talking about today. Hopefully give some color to, I'll get a grade from my partner later if I answer this question right.
Yeah, it was excellent. I'll wrap up with a last question to Jay. Nikita just asked about how do you value e-commerce businesses? You know, they're asset light. They're mostly inventory. There's a lot of IP. How do you do those type of deals? How do you value them? And then someone asked about the Series LLC. Maybe you can quickly just talk about what's the difference between a Series LLC versus a corp and how that works.
Sure. In valuation, I mean, in the very, very early stages when a company is just a PowerPoint deck, it's very much like, you know, the quality of the founder, the background of the founder, the space that they're going after. So it's a little bit harder to value it then, but once they're launched and they're running, you know, what the two numbers that we always care about is like, what's your current, you know, run rate? Like, are you doing $1 million a year run rate? And then what's your growth rate, right? So you kind of like say like, hey, you might have like only a run rate of $500,000 a year, but your growth rate is 50% month over month. I'm going to overpay for that business than a business that's doing $1 million run rate, but growing only 10% month over month, right? So I think the combination run rate plus, you know, growth rate are critical over here, but also sector matters. So if you're in, like, for example, the pet sector, when a pet company gets acquired, it gets acquired for usually 8x multiples, right? So like, if you have a hot pet company, I'm willing to pay more for that because I know that the acquirer, Mars or someone down the road, or General Mills is going to pay a lot of money for that over there. So the sector matters as well too. So sector, growth rate, and, you know, run rate are the three metrics over there. And then your question was on the series structure, right?
Yeah.
So on that one, the way to think about it is like, you know, if I were to right now buy real estate, if I were to buy like properties and, you know, if I were to buy 3 different houses, I usually would, in the traditional world, I'd set up as 3 different LLCs if I'm doing this for business purposes. Why? Because it confines the liability of that business. If I have 3 different investors in the 3 different houses, it allows for each investor to have siloed interest that's legally just there, not, you know, commingled with other ones. The Series LLC really came about originally because of real estate, and they're like, why, you know, if I'm a big real estate investor, I literally have to create 40 or 50 LLCs and do all this tax work. The IRS understood that, Delaware understood that, and so they created saying, hey, you can create an LLC that's defined as a Series LLC, and you can have up to 200 series in that LLC, and each series by law will be protected as an individual asset of itself, and you can apply for individual loans for that series as long as you do certain things like have a separate bank account for that. You could potentially have your own EIN, but the IRS eased that regulation up, saying you don't have to have a separate EIN. If you want to keep everything under one EIN, that's fine. Now, the real advantage of the series has become to investors and venture funds, and especially special purpose vehicles, or SPVs as we call them, where people are like, hey, I'm going to create a Series LLC, and I plan to do 10 deals in 5 years. So 2 deals a year, where I'm going to bring in friends who are going to put in $500,000 into each deal and buy a bar here, a restaurant here, a digital e-commerce business there, and whatever it is. I'm just giving you like a long example, but then those people can come into what they want, and they can invest in a particular series, knowing that they're protected for that particular series over there. And for me, it makes the administration a lot easier from a tax standpoint, from a legal standpoint, and also from a standpoint of pure simplicity over here. So it's actually something that's very popular. A lot of law firms are really doing a lot of LLC work nowadays, Series LLC work, because it is a structure that gained a lot of popularity.
Excellent, excellent. So thank you, panelists. I'm just going to wrap it up. We talked about how to raise capital from private equity or organic growth, operational challenges in the world of roll-ups, what problems you'll face sourcing deals, working on due diligence. When I look at roll-up acquisitions, I focus on 3 different tenets: creating a long-term vision, having an efficient tax structure, and creating culture. So creating that deal team, creating your operating team are critical. So thank you to the panelists, Jay, Kamal, and Ike. This was very helpful. Vishal will wrap it up and discuss what else the Punjabi Chamber of Commerce has in store for 2020.
Yeah.
Thank you, Vijar. Thank you very much. Thank you to the panelists. I really appreciate Kamal, Ike, Jay. I want to just talk quickly for 1 minute about Punjabi Chamber. When we do events like this, I'm going to share this page. When we do events like this, it just boggles my mind that we have a resource like this, which Gary and the team put together. And we're so proud of the community we have built and no wonder we're growing this fast. What is the reason? We are able to bring people like Ike, Kamal, or Jay, and thanks Vijar for doing this. We have people who are building hotels, we have CPAs, we have lawyers in the group, we have youngsters who are going to college, who are starting their first job. So the network here is something that you can tap on to, if you're looking to learn, if you're looking to grow, or if you're looking to give back. So people like Ike, Jay, and Gary and Kamal who are giving back to community. So we want to, my message is a broad message to everyone. If you're looking for something and you're looking to grow, come join Punjabi Chamber. If you're looking to give back, come join Punjabi Chamber. It's free. It is free right now. It will always be free. We have chapters across all the globe. We have chapters in India. We have chapters in Canada, and we're starting chapters in UK, Australia, and all over the globe. And soon we'll be able to say we are in more than 20, 30, 40, 100 countries. So I encourage you guys to join Punjabi Chamber, and we'll look forward to seeing you as part of the next event. Thank you very much, everyone.
Thank you so much. Thank you.
Bale. Excellent. Thank you, G.
All right. Thank you.
Bye.
Thank you. Bye-bye.
Thank you. Bye-bye.